A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older, and it has unique features to make the HECM a valuable tool in retirement planning and aging in place. In this video, we're going to take a look at how HECMs help in retirement by reducing your monthly mortgage payment obligations or providing an equity release to help with supplemental income. Aging in place is the primary purpose of reverse mortgages. Avoid that nursing home for as long as possible. But it's not so easy to age in place. It takes planning and some practice, but there are great advantages. Being independent is the biggest advantage. I'm not big on personal possessions, but having a pet, being close to loved ones, and controlling my cost of living is important to me. I think as we get older, the most important thing is having control and being protected. To age in place, you need to become a risk manager. You need to risk manage your environment. Is your home age friendly? You have to risk manage your health, your mind. You got to reduce mortgage payments. You got to get tax-free cash. You got to supplement low investment returns. You got to offset declining income. You got to have a backup resource when emergencies arise. A reverse mortgage can help you in these. So what can a reverse mortgage or a home equity conversion mortgage do for you? Well, initially, it can help with cash flows. It can reduce existing mortgage payments, eliminate them entirely. It can add monthly tax-free cash flow. And if you don't need the cash, it can certainly help build up a financial reserve against unexpected future costs. It can help with investments and asset values. You can buy a new, nicer, age-in-place home with no monthly payments, at least until the loan was called due and payable. It can help manage investments. You can use a HECM for cash flow if you wish to avoid selling investments for valuation or tax reasons. Or if you're worried about future home values, HECM can help at least partially hedge your home value. It can help in very particular circumstances. You can use a HECM instead of a charitable gift annuity. It can ease late in life, gray divorce, as we now call it. And it can help sometimes. Better than a forward mortgage, it can help after a bankruptcy. Equity release or reverse mortgages help older adults who find themselves possibly, but not always, cash poor but brick rich. It's that simple. It liquidates your savings locked up in your equity while allowing you to stay in place so that you can have security, control, and choices. So what exactly is this reverse mortgage? Well, if you're familiar with traditional mortgages, and most of us are, you know that traditional mortgages amortize down and eventually pay off. You're putting cash in, and the cash in increases as debt declines and the homes increase in value. Reverse mortgages increase in balance if no payments are made, as interest and insurance is added to the outstanding balance. Equity, essentially, is declining because cash has been taken out of the property. So what is a HECM? Well, it is a loan. It's debt on your principal residence. You do have to pay it back when the last borrower leaves the home. And as with any mortgage, you have to pay the taxes and insurance or face possible foreclosure. You don't sell your home to the lender, though, and it is an optional repayment loan. You can decide not to make a monthly repayment or make no repayments at all. Your credit is not impacted. You will never owe more than the lower of the value of your home or the balance of the mortgage. It is a non-recourse mortgage. You can access your money in a variety of ways, such as a line of credit or a guaranteed annuity like monthly payment. If you have a line of credit, any unused balance on that line of credit will grow monthly at the current interest and insurance rate. It can at times exceed the original value of your home. And any equity left in the home is yours and can be bequeathed to your heirs. So how is a HECM different than a conventional reverse mortgage? Well, under the HECM program, the property values are limited to a maximum of $636,150 for the purposes of calculating the gross loan amount. This does not mean that your home is not worth $1 million or more. It just means that for the purposes of calculating the dollar that we will lend you, this is the maximum appraised value we will attribute to your home. As we've discussed, the unused line of credit can grow, and it's a full non-recourse loan. But there are important other features, one of them being the non-borrowing spouse protection. In the past, non-borrowing spouses may have been asked to leave the home if the borrowing spouse had died or passed away. Now, non-borrowing spouses are protected, provided they're qualified and disclosed at the origination of the loan. Also be aware that all of the funding and the program mechanics are guaranteed by the U.S. government. This is important if you're going to live 30 years or longer, and you want to know that the U.S. government is standing behind all the lenders who owe you the money and can make you the payments. And finally, FHA lenders are required to help with any tax and insurance defaults. If you temporarily get behind, they can advance the money, even if you do not have it available on your HECM, to pay the tax and insurance and other property charges. Of course, you have to pay them back, and the pay period usually is between 1 and 3 years, depending on the size of the advance. If you fail to pay them back, or you go delinquent again on property taxes while the advance is outstanding, you can possibly find yourself in foreclosure. So how do you get one of these home equity conversion mortgages? Well, all borrowers on title must be at least 62 years old or older. You must have sufficient equity in your principal home. This must be your principal home. It cannot apply to an investment home or a vacation home. It has to be the home in which you live principally during the year. And you need to have sufficient equity in that home to be able to get out a HECM. And you must have minimum income to look after yourself, meet other financial obligations, and pay the annual property charges. So how do we calculate a reverse mortgage? Well, it can be complicated. So you will have to follow along, and I will give you a couple of examples. Basically, we take the youngest co-borrower's age, and we figure out the remaining life. FHA gives a minimum qualifying interest rate. Currently, it's about 5.06%. But if you take a high margin loan, you might exceed that. And we take the appraised value of your home, but only up to a maximum of $636,150. We assume you make no payments. We assume you draw all available proceeds immediately. And we assume there is some property appreciation in the model of 1.5 to 2% over the remaining life of the younger borrower. Based on that, we can figure out what the unpaid interest and mortgage insurance that could be estimated, assuming you took all the money immediately. We figure out that unpaid interest and mortgage insurance over the life of the youngest co-borrower, and we factor in some of that property appreciation. The balance, what's left over, is available to you. So let's look at how we calculate your gross loan amount, or what HUD calls your principal limit. The principal limit factor is the primary assumption here. It is the percentage of your appraised value that will be your gross loan amount. This factor is based on your age, the youngest borrower, and our estimate of that person's remaining life, along with the FHA expected or qualifying rate, which we provide to FHA. The FHA provides the factor. In this example, at age 72, you could get a gross loan of 58% of the appraised value, subject, of course, to the maximum appraisal under the program of $636,150. You will notice that as the age increases, the principal limit factor also increases. This principal limit factor is the percentage that you will borrow of your home value. Basically, the older you are, the shorter your remaining life. The shorter your remaining life, the less interest and mortgage insurance reserve we need to reserve for. A smaller reserve means that you will have more money available to borrow. If you look at the second half of this chart, where the FHA expected rates, remember this is not your mortgage rate but the qualifying rate, are increasing by 1% over the same age range, you will notice that there is a substantial drop in the principal limit factor. This is because more needs to be reserved to cover possible future costs, so you get less. Rising interest rates are not friendly to HECMs if borrowers wish to take down a large portion of the proceeds immediately or in the future. Let's get a bit more specific. Note the assumptions we're using and that the maximum appraised value of $636,150 applies to the program. Also note that if there's a non-borrowing spouse, we are required to take their age into account. If they are younger than the spouse on title, we must use that age to do our calculations. And a non-borrowing spouse can be younger than 62. However, all borrowing parties on the title must be at least 62 years of age. So as noted previously, we take the youngest borrower or the youngest non-borrowing spouse. We figure out their estimated age at debt based on annuity tables. And from this information, we know their remaining life. And we calculate how much of the appraised value is remaining if we reserve all the interest and insurance, assuming they took all the money immediately, never made a payment, but we do include some modest home appreciation of 1 to 2% over the period. So interestingly enough, in a HECM, you do get credit for future property appreciation. And we apply that factor to the appraised value, and you can see the amounts are calculated here. Let's take a real example. Assume a $400,000 appraisal with a 62-year-old borrower and the FHA minimum expected rate or qualifying rate. That appraisal is essentially divided between what the borrower could take out immediately and what we need to reserve for interest and insurance on the loan based on the inputs we discussed on the previous slide. In this example, $204,000 is available and $196,000 is reserved for unpaid mortgage insurance premium and interest. But if the portion is unused, the line of credit will grow annually at the rate of interest and the insurance cost. So what happens if this loan is not used for 5 years? Well, the available amount under the line of credit would grow to $269,000 because $66,000 of interest and mortgage insurance reserve was no longer required. If the line was unused for a long time, it could exceed the original appraised value and could also exceed the then current market value of the home. Under the program, even if we know there is a deficit, even if we know the line of credit exceeds the then current market value, the borrower can still draw 100% of the available amount. In this way, a HECM can actually be a hedge against declining real estate values. So what does a HECM loan look like over its outstanding period? Well, if no repayments are made, the outstanding balance grows, and unless the home is increasing in value at roughly half the annual cost of the HECM, the equity in the home will decline over time. However, any unused or repaid portion of the HECM will grow annually at the same rate as the annual cost of the HECM. Kind of one of those strange things. If you don't borrow the money, then we don't need to set aside a reserve to cover the interest on the mortgage insurance. If you never use the money in the course of a year or a month, we give back that reserve to you by increasing the available credit. Basically, though, if you drew all the money out and accrued all the interest and mortgage insurance premium on the loan, that same dollar amount that you would owe at the end of, say, 10 years would actually be available to you at the end of 10 years if you never used the HECM at all during the same 10 years. That's because the unused line gets the same annual percentage credit for any unused portion as the used portion gets charged annually. I mean, if you think about it, this makes sense. If I never use the line, then the line gets the credit. If I use the line, then of course the line and the interest on it is going to eat up the available credit. So let's look at the major facts. Let's get clear about them. You don't sell your home to the lender. You can make monthly payments. You're not forbidden from treating it like a regular mortgage. If you do not make the payments, your credit score is not impacted. You do have to pay the property charges, just like you do on a regular mortgage, like you would whether you had a mortgage or not. You own the equity in your home, and you can leave it to your heirs. However, you never owe a deficit. This is because you pay mortgage insurance, and the mortgage insurance absolutely guarantees that if at the end of your days, when you leave the home, the balance on the mortgage is greater than the value of your home at that time, all you have to do is hand the home to the lender. You will not owe them any more than this. It's what we call a non-recourse loan. So again, not to overdo this, what is the big deal about a reverse mortgage? Well, it takes much less income to qualify than a forward mortgage. You may use the investments and savings and unused HECM line of credit dissipated and treated as income rather than the yield on the investment as income. There is no minimum credit score. There's absolutely no deficits on final repayment. And the available credit, because it grows over time, could exceed the home value. It could certainly exceed the original home value, and it's possible that it may exceed the then current home value when you need to sell the home. You do get credit for future property value increases, albeit you may not get credit at the same rate that historically home values have gone up, but you do get credit for between 1 to 2% annual home appreciation. And finally, all of this is insured by the government. Basically, the insurance by the government makes certain that the program is there for you throughout your life and that the lenders can never fail or bankrupt themselves or leave the program and take your money that they owe you with them at that time. So how can a HECM help you? Well, it can eliminate your monthly mortgage payment if you wish by refinancing an existing amortizing traditional forward mortgage loan. If you have no mortgage loan, you can do a cash out and it can supplement monthly cash flow, tax-free. It could finance that dream home that you wanted to buy, or it could finance a second home. It could also finance a reserve for future long-term care insurance or insurance deductibles, or simply just fund yourself in the event that you think you're going to have long-term care needs. It can help even out investment earnings and permit laddering. And if you require it, it's not a bad home value hedge. The outstanding line of credit with a high rate of interest can possibly grow past the value of your home over time. And finally, it can help with tax planning. Simply because of the way the HECM works, you do not get an interest deduction for tax purposes until you pay out the actual interest expense. If you're thoughtful about how you go about doing this, a HECM can definitely help you with tax planning. So here is a quick summary of the advantages, which I think we've already discussed extensively. And here are the disadvantages. One of the big disadvantages is the high upfront cost if you have a high initial usage. And of course, you surrender equity. You have to meet your property obligations, but I think you have to do that with any mortgage. And if you're not careful, Medicaid might be impacted if you don't manage your proceeds carefully. But overall, I think the HECM gives you some significant advantages. And provided you use them responsibly, HECMs are a wonderful way to help fund aging in place. One of the questions we get asked constantly is if I don't really need the HECM or need the proceeds from a HECM now, then why should I do it sooner rather than later? Okay, so let's compare if we do this now versus 10 years from now. Your choice here is to get the HECM now but don't use it for 10 years, or wait and apply for a HECM in 10 years when you're older and your property no doubt has gone up in value and you're probably getting the higher percentage of the property value in a HECM loan. So why do it now? Well, it turns out that if you get the HECM now, the increasing unused line of credit feature, that feature that if you don't use the line of credit, it grows at the annual interest rate plus mortgage insurance premium, will grow your HECM faster than the average appreciation of your property, combined with the principal limit factor increases over those 10 years. In our example above, for a $400,000 property, the difference over 10 years could amount to $55,000 more gross loan available if you do the HECM now than if you wait. That's a big difference. And it's very likely you could get this loan with minimal closing costs. Another thing to remember is that in 10 years' time, it's not a guarantee that your property will increase, or for that matter, the interest rates themselves don't increase, or that your income doesn't decline, or was not sufficient to get the loan, or indeed that the program itself is available in the future. We don't encourage you to go out and get this loan if you don't need it. But if you think you may need it, seriously, it probably makes a lot of sense to explore getting a HECM loan now and paying a minimum upfront mortgage insurance, rather than waiting for the future when uncertainties enter the picture and you may not have enough income, the property may go down in value, or indeed the program may not exist. So we encourage you to take a close look and decide whether or not, just for planning purposes, you should consider taking out a HECM. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.